All right, what's going on, everybody? So I am recording live in two different areas right now. So I'm right here recording live here, and I'm recording live right here. So if I look down, if I look up, it's because I'm recording live on both platforms. So I wanted to talk about how do you avoid taxes, right? Let's talk about that. How do you avoid taxes? And when I say avoid taxes, I don't mean like, oh, we're just going to skirt the IRS because that will land you in jail. And you guys got to remember, every video that I shoot is to help you live a better life where you have more free time. So if you go to jail, then that is not actually helping the cause because you won't have more free time. Well, maybe you will, but you just won't be where you want to be. So let's talk about how do you reduce your taxes? How do you avoid paying taxes? How do you minimize your taxes? All that kind of stuff. But first, the little caveat of I am not a CPA or an attorney, but I do know some fun things that I've applied to my own life that I've heard from other CPAs and attorneys. So if it applies to you, great, use it. And if it doesn't apply to you, then this video is for entertainment purposes only. So let's talk about the advice that I always hear. The advice that I always hear when it comes to trying to reduce your taxes. So they say hire a good CPA. Hire a good CPA. Well, how do you know if they're good? If you don't know what you're talking about and they're telling you something or they're not doing something and they miss something, how do you know, right? How do you know? So hiring a good CPA only goes so far because you don't know if they're actually good. So let's talk about how we can reduce our taxes so that we don't have to work so hard and have the life that we actually want. All right, so let's start with the fun things, right? Let's say you wanted to buy a brand new car. Well, fantastic. Guess what? You get to. And based on the tax laws, you get to buy a vehicle that's over 6,000 pounds. So that's like a heavy SUV, a heavy truck, and you get to write off the whole entire thing. So if you made $100,000 and the truck was $60,000, you write that $60,000 off from your $100,000 income. It looks like you made $40,000. So if it looks like you made $40,000, that's way less taxes than if you were making $100,000. So that's number one. Truck write-off, truck, SUV, heavy vehicle write-off, 6,000 pound gross weight. So what you're going to have to do is when you pick the vehicle that you want, look up the gross vehicle weight something, right? GVW, something like that. You'll see it. And if it's over 6,000 pounds, then that qualifies. And it doesn't matter if you finance it or pay it in full. You can finance it. You can put $0 down, buy the truck for $60,000, and you get to write off the $60,000. That is super, super cool, right? So you don't have to put any money down, yet you get to write it off, and then you pay less in taxes. This is why a lot of people end up with really big trucks every single year. So if you ever notice that, that's why. Now, let's talk about electronics. So everybody has a cell phone, everybody has a computer, everybody has a tablet. Write those things off if you have a legitimate business use for those things. The business has a need for these electronics. You have a need for these electronics. The line is blurred between personal and business. So you could depreciate the item, let's say 70-30, 70% business, 30% personal, or something like that. If you want to be super conservative or if you want to be really aggressive, then that whole thing is a business write-off. But you get to if you're a business owner and you use those items for business. So like the camera that I'm using here, the lighting system that I have, everything is going to be a write-off for me. So get a credit card, get a business credit card, use that business credit card, and voila. Track it though. Track it. Make sure you track it and then tell your accountant about it. Give them the receipts. Take a picture of the receipts. You don't have to actually have the receipts, but just have the picture of the receipts. Let's talk about vacations. Everybody loves vacations. How do you make a vacation a write-off? Well, there's a couple of different ways that I would like to share with you. One is buy properties in the different cities that you like to go travel to. So if you have a rental property in, say, Hawaii, somewhere, Honolulu, and you go visit Honolulu, well, that's a business trip because you went to go check on your rental property, not go on vacation with the family, right? Even though you're bringing the family because they're your board of advisors. You guys see how that works? So if you can have your family be your board of advisors for your company, and all of a sudden, when you guys go to Honolulu, Hawaii, and go check on your property, it's a board meeting. It's a board meeting. You see how that works? There's no law saying that you can't have your family members on your board. So if you go somewhere, you're having a board meeting, okay? So make sure you use that language. You are having a board meeting. Now, you can also go check out seminars. I love going to seminars because they just expand my mind and it just shows me the possibilities that are out there. So with seminars, pick the seminar in the city that you want to go to. Say it's a 3-day seminar. Fantastic. You go to the seminar, you hang out for the 3 days, but then you have a couple of days here and there, which are free time. And then the flight to and from, that's also a write-off. So again, we're knocking off expenses that you already would be paying for. So you'd already be paying for vacations, you'd already be paying for cars, you'd already be paying for electronics. Now we're taking these things as a write-off against your income. So if your income was $100,000 and you wrote off your $60,000 SUV, and then you wrote off another $10,000 in electronics, and then you wrote off another $30,000 in vacations, you got zero income, right? And so what do you pay on tax? What are the taxes on zero income? Zero. So let's keep on going, though. Let's keep on going. There was a book called Never Eat Alone. Never Eat Alone. And it was talking about more so like networking with people, picking people that you want to eat with so that you guys can do business together. But what about never eat alone with other people who do business with you, and when you pay the bill, it's 50% off because you get to write off the 50% for the food. They say, well, you got to eat, but then that person you're paying for. So there it is, 50% write-off. And guess what? What if you marry your real estate agent? So my wife is my real estate agent. And when we go to lunch, when we go to dinner, when we go to brunch, we're talking business, legit business. And because of that, when we pay the bill, we get to write that off. I get to write off 50%. Well, she probably gets to write off 50% too. I don't know how that works. Again, check with your CPA. I am not a CPA, but there are ways to write things off that you are already doing. So a lot of you are paying for things with after-tax dollars, meaning you get paid, you pay the tax, and whatever's left over, you go and spend it. Now you're not going to have as much because you've paid the taxes. But what if you get paid, you use all of it for your food and your this and that, whatever it is, and then you go and pay taxes on whatever's left over? Isn't that a much better deal? Right? So that's what I'm showing you today with all of these things. Now, what else? What else do you guys pay for? Already pay for. Well, what if you wanted to live in an amazing house, right? Who am I to tell you that you don't deserve to live in an amazing house, super big house? So how do we write off the house? Well, we're not going to write off the whole house. Let's not be too aggressive here. But something that is commonly done is where you create a home office. So in the 7th bedroom of your 10-bedroom house, create a home office there. That home office is now a write-off. And so let's say that home office, that 7th bedroom is the big bedroom, right? And let's say that big bedroom is 10% of the house. So you get to write off 10% of the utilities for that room. You get to write off 10% of everything pretty much, right? Because 10% of the house is used for legitimate business. So your business has an office and it just happens to be in your house. And so you can take a home write-off, right? So talk to your accountant about how to structure that as well. I keep going back to that because I am not your accountant. I am not your CPA. I am not your attorney. I'm none of those things. I am just your friend. And I'm just some guy creating a video because there are some really cool tax tricks that I apply to my own life so that I don't have to pay as much in taxes, so that I get to do what I want without having to work so hard. Remember, if you get paid and you can keep more of it, that means you don't have to make as much to have the same lifestyle. I am not telling you to reduce your lifestyle. I'm not telling you to degrade your lifestyle. What I'm telling you to do is I want you guys to have the life that you want without having to work so hard for it. Doesn't that sound good? At least it sounds good to me, right? So home office, write off the portion that is your business. Now, what else? Why do you have this 10-bedroom house? Because you probably have kids. So with your kids, guess what? Your company can pay your kids. And if your company pays your kids less than the standard deduction, then all of a sudden, they don't have to pay taxes and you got the write-off. And so currently, standard deduction is $12,000. I think it's a bit more now, but let's say it's $12,000. If I paid my son $12,000, that means I got a $12,000 write-off against my income. Remember, $100,000 income, knock off the $60,000 SUV, and then let's say I knock off $12,000 because I pay my son, right? Literally pay him through direct deposit. So by paying him, now I have the $12,000 write-off. But then you're thinking, oh, well, he has to pay taxes on $12,000 or whatever I pay him. And the answer is he doesn't, because he has a standard deduction. He has a standard deduction of $12,000. So if he has $12,000 coming in and then 12 going out because of standard deduction, well, voila, zero in taxes again, right? We're trying to get down to zero. Let's get to zero. Get to zero. And this is the game that we get to play. This is the game that we get to play. So now, what do we do once he has the $12,000? Well, it gets direct deposited into his checking account. With his checking account comes a debit card. You take that debit card and you go buy the toys that you were going to buy for him. You go pay for the recitals. You go pay for the prom. You go pay for whatever it is that you're going to pay for anyway with his money. Now you're doing it with before tax dollars, right? Because I put $12,000 in there. I put the $12,000 into his checking account, and then now I have a full $12,000. It was a write-off for me, and he doesn't have to pay any taxes because standard deduction is $12,000. You guys following along? You guys getting this, right? This is some good stuff, because if I can get your taxes to zero, and then that means you get to keep all of that money that you used to have to pay. And taxes is one of the biggest expenses that you all have, right? So we can keep on going. Now, again, people say hire a good CPA. How do you know the CPA is good if you don't know what you're talking about? So it's super important that you guys understand this stuff. So let's talk about stuff that you need, right? I've been talking about the fun things, your cars and your electronics and your vacations, your food, your kids, your home. Now let's talk about life insurance, health insurance, retirement accounts, all that kind of stuff. As you guys already know, if you guys put your money away in a 401k at work before you actually get paid, they take the money out. That 401k contribution is tax deductible. So that's a good way to bring it down. But if you're self-employed, what do? You don't have a 401k, or do you? You can create your own 401k if you have a business that is an S corp that pays you a W-2, then as an employee, you can get a 401k, and as the employer, you can match your employee's contribution, which is more of a write-off. So whereas in a regular 401k, maybe you can only put away $18,000 or something like that, where you do, if you're the employee of your company and you're the employer and you do the employee match, you can put away over $50,000 now, right? Clever little things if you understand how they work. So that's your retirement account. Now, if you do something like a self-directed Roth IRA, now we're getting really advanced, and I'm probably going to create another video on this, but a self-directed Roth IRA, that will allow you to use money to buy investment properties, and then when that investment property makes money, it goes back into the IRA. And then when you're ready to retire, let's say 59 and a half, when you're ready to retire and you want to pull that money out, completely tax-free. Right? So that's the cool part. Completely tax-free money when you put the money in the Roth. You do your investments in there. Later when you retire, you pull it all out, tax-free. You live a great life, right? It's awesome. It doesn't matter how much money you have in there. You can have millions, hundreds of millions of dollars, which some people do, and they don't have to pay any taxes on it once they pull that money out. Now let's talk about health insurance. So people who are at a W-2 job, they get their health insurance, but their portion that they pay is not tax deductible. But if you're self-employed, when you pay for health insurance, that part is tax deductible. So guess what? There are benefits of being self-employed. So having that self-employed status and then buying your own health insurance, when you take a look at it from a holistic approach where you're looking at paying for your health insurance with after-tax dollars at your job, or when you escape and then you're on your own and then you pay for it with before-tax dollars, the difference isn't that much. And a lot of people get really scared about that health insurance thing. But what I've just done and showed you is I've closed that gap. So if the gap is only like, let's say $200-300 a month difference, or even $500 a month difference, don't allow that to scare you from making the leap. Because everybody says, oh, I can't escape my job. What do I do about health insurance? Well, there you go. That's what you do. You just buy it and it's a write-off, and that's fantastic. So be okay with that. Life insurance. Life insurance done the right way allows you to build wealth. So I help people create life insurance policies where when they pay their money into the life insurance policy, it grows in value. You can take that value out and you can use that money to go invest in things. And so while the money is in the policy, it is growing and growing and growing. And then what we're going to do is we're going to borrow against that policy. We're going to take the money out as a loan. And because we take the money out as a loan, we don't have to pay taxes on the money. Isn't that cool? We don't have to pay taxes on the money because it's a loan from the policy, and yet there's more money available for us to use because the policy got larger and larger and larger. So that's a neat little way that people use to grow their money, protect their money, and not have to pay taxes on it. So let's go deeper into the whole borrowing thing, right? So if you own real estate properties, if you're doing it correctly, you are buying properties that are less than what they're worth. So here's the value and here's what you're all in for, right? So let's say this is $200,000 and let's say you're all in for $100,000. There's an extra $100,000 in equity in there. Well, guess what? If you borrow that equity, you don't pay taxes on that. That is a tax-free loan. Most loans are tax-free. So that money in there you get to use for whatever you want. Cash is cash, even if it's in the form of a loan, because there's no store in the world where if you pulled money out as a loan and you went to them with this money and said, hey, I got this money, I want to buy this product. There's no store in the world that's going to be like, oh, sorry, sir, we don't accept that because that came from a loan. So if you understand that little premise, that just means that you have access to a lot more tax-free money. This is how people like Robert Kiyosaki gets really rich. He talks about this all the time, how he uses debt to get wealthy. So he has these properties that appreciate over time. They have principal pay down, so they have less debt. And then they have all this equity. If he borrows that equity, he can use that equity to go buy whatever it is that he wants. So I'm going to be doing videos on that later as well, but I just wanted to expose you to the ideas. As a real estate investor, there's a couple other things that you want to consider. So if you want to pay less in taxes, then you can buy a property, rent it out, hold it long term, meaning over a year long. And then when you sell it after that 1 year, then you have to pay long-term capital gains versus short-term capital gains. Short-term capital gains occurs when you sell a property before owning it for a year. Long-term capital gains over a year. So that difference, right? That difference is probably 20 to 25% in taxes. So that's a significant difference. And it's just because of that 1 year mark. Now, if you don't want to pay any taxes on it, even though it's a reduced amount because of long-term capital gains, you can do what's called a 1031 exchange, where you sell a property that you've been holding. You sell the property, you go buy a property that's higher in value, larger properties typically higher in value, or you can buy multiple properties that when you add it all together is higher in value. So when you go sell that one property and go buy the next property, you don't have to pay any taxes on that either. Right? So that's a 1031 exchange. Or if you sell your primary residence and you are single and make less than, and the profit was less than $250,000, then right there, you don't have to pay taxes there. Or if you're married, $500,000. That's all these ways to avoid paying taxes, because if you avoid paying taxes, you don't have to work so hard. And then you get to have that life that you want. Now, the final one about real estate and how you write off stuff, and this is one that I'm applying to my life right now, is cost segregation, right? So there's this thing called depreciation, and then there's bonus depreciation, and then there's cost segregation. All of that fluffy stuff to say that when I own a business or when I own a building, it kicks off losses. Losses meaning that it's as if the building is losing money. So I have losses and then I have gains. So my gains come in, but then my losses kick out. Cost segregation, depreciation, bonus depreciation, those are like phantom losses. I don't actually pay money to experience those losses. Whereas with a vacation, even though I'm writing off the vacation, I had to pay money for that vacation. I'm just using before tax dollars, right? But I'm paying money. Depreciation, I'm not actually paying for, but I get that loss on paper. So I take that loss and I apply it to the income that I made, right? I take the losses, I apply it to the income, and it washes it. So then I don't have to pay any taxes on the money that I made. So that's a really powerful thing that people do when they own real estate. This is why I do real estate. This is why I suggest you guys do real estate, even if you're not passionate about it, because I'm not passionate about it either. But it is a very powerful tool for people so that they can create wealth and then not have to pay taxes on it. Again, taxes are one of your most expensive things, but if you could figure out how to not have to pay taxes on all the money that you made, then all of a sudden you either have way more money or you work way less and have the same results. And that's a win to me. And hopefully you guys apply all this stuff that I just talked about. So I ran through a ton of things. This video, 20 minutes long, whatever it is, I just wanted to put out there. I wanted you guys to get the exposure to these ideas and concepts. This way you then can apply it to your life and at least have a great conversation with your CPA, because they say hire a good CPA, but if your CPA doesn't know all of the stuff that I just talked about, then maybe they're not a good CPA. But now that you know this stuff, you can then question your CPA to see if they know what they're talking about. All right, guys, with that, thank you guys for watching. Hopefully you have subscribed to the YouTube channel. If you have not yet subscribed to the YouTube channel, go to hoanzone.com/YouTube. Okay? hoanzone.com/YouTube. Make sure YouTube is all lowercase. All right, guys. See ya.